Up next, we have a topic near and dear to my heart as a former tax auditor a very, very long time ago. I'd like to welcome Alex from BDO, who will take us through...
Sorry, Ali.
Oh, sorry.
Okay.
I'll check my writing.
Okay.
The general tax implications of IFRS 17. Thank you and welcome.
Thank you. Thanks, Kylie. So this is hopefully not a dry topic, certainly one that whets my appetite, tax. And being an insurance specialist, certainly this is near and dear to my heart. Whenever I turn up in a room, people talking about IFRS 17, and I mention tax, they don't want to talk to me. They just start walking away. Oh, we haven't thought about that. We'll worry about that later. And that also includes the tax office. They're also saying, worry about that later. APRA will worry about it later. So I'm sitting there going, well, okay, it's coming. You need to worry about it now. You need to start thinking about it because 30% of a number is how much you're going to pay in tax. And I had a look at the stakeholders that we had in those project timelines, and none of them included tax people. So it's quite interesting. I know that they do include them, but they're just not named. I don't think people like talking about tax for some reason. Look, what I thought I'd do today is sort of, refresh on some of the concepts around tax. I won't get into a lot of detail around what it is, but I want to give you enough background around, the landscape, the timeline of the tax journey. And look, life insurance in particular is quite complicated, not only in the regulatory world, but it's also in tax. And GI and health are a subset of that complication as well. I'll also take you through Treasury consultation. So there's a requirement either to change law, and if there's no change in law, then there'll be particular impacts that need to be considered, and it will impact revenue. So, just like it will impact the company, and the company needs to start thinking about, well, what's it going to mean for the bottom dollar? There'll be an impact for the revenue. So obviously Treasury have put out consultations around that. I'll talk to you about the current landscape. I'll talk to you about the tax impact of the new standard as I understand it and think about it. I know there are changes and it will be moving, but we need to start thinking about what those look like. And I would even go as far as suggesting that tax needs to be taken into account in your modelling in particular. So you need to think about, well, what's the impact? What's the dollar impact if it goes either way? And start talking to your stakeholders and managing those stakeholders. The other thing that I'll take you through is the tax issues that are still, going to remain on the table or on the table for discussion that we can probably engage with in terms of deliberations, either with, APRA, Treasury, the tax office. So they're saying, look, we're open to discussion. So it's up to companies to start thinking about, well, how does it impact me? And what am I going to say? And how do we lobby for change if we need to? So just some background. There's a lot on this slide, and I just want you to take away a couple of things. So as I said, and there aren't a lot of life insurers in the room, but we'll cover it because I think it does impact life insurers quite a lot. So life insurers are taxed under a code, Division 320. Income earned by life insurers taxed in a comparable way depending on the type of business that it's writing. So risk business is generally taxed in a way similar to general insurance. Annuity business is taxed, like effectively a investment vehicle, and super, depending on the phase, superannuation's taxed like a superannuation fund. And so there's exempt from taxation, there's 15% tax, and there's 30% tax. Complicated beast. And in terms of thinking about how that taxation regime works, I'll take you through the complications around valuation methodologies. I'll take you through complications around the assessment from a tax perspective. General insurance is also covered by a code, Division 321. And Division 321 is taking together all the case law that came out as a result of the Mercantile Mutual case many, many years ago, the tax office rulings, and the many iterations that formed into what's now Division 321. And I'll take you through that. But basically, Division 321 and IT 2663, treat assessable income deductions flowing to a general insurance company. Its accounting result should be very similar to the tax result, except for a few minor exceptions, putting aside investments, of course. Health insurance, it's a category of GI, but there's no specific code for the taxation of a health insurer. It's not covered under Division 321. It's not included in the definition of general insurance when you work through the Tax Act. So it's sort of sitting there on its own, but the principles are very much similar to Division 321 in terms of how people treat that particular vehicle. So I'd say it's unique, but it's very similar to GI. So I'd like to take you through the journey around income tax. So life insurance business has always been complicated. Pre-RAF reforms, the tax regime around life insurers was distorted, and there was a lot of change that happened to basically get the policy alignment to be that risk business is actually treated like a GI business, and so taxable at 30%. And there was a segregation between VPST and SEA business, and so Division 320 was born in 2000, which came out in response to that RAF review. In relation to GI, we had the codification of the tax ruling IT 2663, which emanated in Schedule 2J of the Tax Act, and it was rewritten as part of the rewrite into the 1997 Act later, which is still going, by the way. And we know that Treasury have, there are a number of other things that have been going on around claims provisioning for GI, but the big events are these. Treasury have released a paper asking for consultation. The consultation periods ended in January 19. Treasury haven't come back with a response around that. We do know that there were 5 submissions made by the GI and life insurance and health insurance industry. Sorry, I'll just go back. So Treasury consultation process, they basically asked for consultation. They put out, amongst other things, so they asked what people thought of IFRS 17 and what the impact of it. People have modelled the impact, including numbers around accounting as well as taxation impact. They asked for people to put forward their views. They also asked a number of other side questions which are timely, which include things like, should we bring in a set of legislation in terms of health insurance? Should we align tax and accounting? What are the other issues? So what we do know is that Treasury and APRA and the ATO are all working together and with stakeholders. I sit on the FSAA committee around where we're talking about that sort of stuff. But as far as I can tell, they haven't shared very much information other than we're waiting for the standard to sort of see what it looks like, and then we'll decide. But as I said, there are a number of impacts that we can start talking about now and modelling what that looks like. So what's the current position? I touched a little bit about it, but so 1023 applies to GI, general and health insurance, and 1038 applies to life insurance contracts. It's interesting because APRA obviously sets and enforces the prudential standards, and life insurance in terms of the tax regime under Division 320, it refers to the life insurance regulations, the LPS standards. In the GI context, Division 321 doesn't refer to the APRA requirements, but it refers to what the company is required to set aside in terms of reasonable estimates. And on the health insurance side, it's ordinary principles, case law. So, we've got quite a different treatment depending on who you are and where you play. And as I said to you, the complication is around sort of the different types of businesses. So what's the tax impact? Depending on what type of business you are, we know that deferred acquisition cost is a problem. So if you're in the life insurance space, deferred acquisition costs, because of the contract boundaries, big issue. We know it refers to costs regarding insurance contracts. These costs are commissions paid to agents, business selling, underwriting costs, advertising, and we know that changes things. We know that depending on the type of policy, for life insurers, it's a change in treatment, and it looks to the life insurance standard, not the accounting standard. So if the tax law doesn't change, then we're going to have this mismatch. We're going to have a timing difference. And so effectively what's going to happen is we might bring all our deferred acquisition costs up front from an accounting perspective, but not from a tax perspective under Division 320. So, this is sort of at odds with what we'd expect to see in a normal business. So the question becomes, well, why shouldn't we get a tax deduction for deferred acquisition costs? So here's a summary of the impact, and this is between life, health, and general. And starting off with life, basically we're saying lower profits in early years and higher profits in later years will affect contracts. And basically the link between the valuation standard, which ties in with the tax rules, is what's going to drive things. So there needs to be a change here. Either we change the tax rules to align with the accounting, and there'll be a transition event there, which will have some sort of impact. On the GI side, we think there'll be a modest impact due to the shorter contract terms, with the exceptions of long-tail insurance, like maybe PI coverage or something like that. So you still need to obviously think about, well, do we get a deduction up front? Under Division 321, it looks to the amount set aside to keep aside for reasonable estimates. The question is, well, what's the impact here? And we can model that, and we should be modelling what that impact looks like. And so I'll talk next about other adjustments. So risk adjustment. I mean, this is a change in the life space. We're used to risk adjustments from a GI perspective, and the ATO have traditionally challenged in some cases where the probability of adequacy, for example, is above the APRA requirement. There's nothing said in the tax legislation saying what the perfect number is, and so you've probably seen in the GI space, the ATO have asked companies to sign a declaration, for example, where the OCL is above 75%. And this is part of the administrative process the ATO are going through to get comfort around the provisioning. But again, Division 321 doesn't require that, and we're going to a space where life insurers are now going into this risk adjustment process. So is the ATO going to come in and ask for that? What's the appropriate level? At the moment, you just apply the prudential standard. So there's a lot to think about here in this space. We expect that it will push out the time to recognise accounting profit and income tax. From a general insurance perspective, the changes won't be as big because, at the end of the day, we're already applying a risk adjustment. And so I think the question becomes, well, will the ATO be satisfied with the accounting number? Is there a requirement for a change in tax law? Do we change the tax law so that effectively tax and accounting align? Similar issues in the health insurance space. So I'll just go into a little bit more detail. Under Division 320, I refer to the LPS standard. So life policies, basically the movement in the policy liability is measured under the LPS 340 regulation, and so that's what's taken into account. The valuations in terms of transfers in and out, so out of the ordinary business into the VPST, into the SEA, all calculated based on the policy liability valuation under the prudential standards. So if we're going to go to this new accounting standard, what's that going to mean? So clearly there's a requirement to change law. Also refer to tax consolidation rules for cost-setting purposes. They also refer back to the prudential standards and not the accounting rules, which is a bit of a difference from what we normally see in other companies. So there's some modifications in the consolidation rules. So what are the implications on transition? Well, we know that if someone adopts early, there's going to be a big impact. There'll be a misalignment between the valuation of continuous disability policies for life insurers. There's going to be a difference in the timing around DAC, and effectively acquisition costs and policy liabilities won't be aligned. And so the current tax rules, you might get a deduction earlier for income tax purposes than what you ordinarily would around DAC. And so clearly there's a concern here from a revenue perspective, and that needs to be managed. Division 321, what we're seeing is it should mostly be similar to the accounting treatment. And yes, there'll be a transitional issue, but it's mostly around that first year of adoption and the question around derecognition of deferred acquisition costs, and do you get it up front as a tax deduction? If that's a big number, then I think there may be a requirement or a need to go a transitional approach. We've seen in the past around introduction of law around, for example, taxation of financial arrangements. 5 years was used to transition to TOFA, so that may be an option depending on what the different stakeholders think of that. We know that reinsurance contracts at the moment under the proposed standard are a problem around how onerous contracts are treated. So the question is, well, on an onerous contract, the underlying risk, I'm effectively getting a tax deduction for that. But on the reinsurance side, if the timing around the recovery around the reinsurance doesn't align, then that doesn't fit the economic outcome that we'd expect under a reinsurance arrangement. So there's questions around, well, is there some issue there that needs to be addressed from a tax perspective? Because you don't want these types of mismatches arising. So what are the tax issues on the table? DAC, we know DAC is an issue, right? So what's the fiscal impact? What's it mean? We need to start thinking about it from an individual company perspective. And what would it look like if we're going to spread it over time? What are the different modelling scenarios? And the ATO are asking, Treasury are asking for these questions, which they're feeding to the ATO, which they're feeding to APRA. So everyone's waiting for the insurers to do something. And I think if we're all going to just wait till 2022, we're going to be in a bit of trouble. So it's definitely something to start assessing now, thinking about what's the impact and where to from here. I've talked about reinsurance on loss on onerous contracts. There'd be that mismatch. And there are tax implications as a result. So depending on what that final standard looks like, and maybe we need to think about where we're going with this in Australia, you need to start modelling depending on sort of the level of reinsurance that you have at an individual level. Acquisition cash flows, the question is, will Treasury accept the optionality for tax purposes? And we've talked about risk margins. So, 4 big issues to think about from a tax perspective. Either there's a requirement to change in law, I think, or, if you don't change law, then there's effectively going to be these mismatches between accounting and tax. So what should we consider? I think there's an opportunity for the government to think about codifying some new tax rules around health insurance. There's an opportunity for harmonisation of basically tax and accounting rules. Whether that's appropriate or not is for stakeholders to decide on. There's a question around transition. Do you get the deduction up front? Do we spread it over 5 years or some period in between? What's the fiscal impact of that? What's the impact for the companies at stake here? How do we deal with anomalous outcomes under IFRS 17 and how do they impact and we talked a little bit about that around reinsurance and ownership on onerous contracts. And also, I think there's an opportunity here to think about fixing up the tax consolidation rules around life insurers and liabilities around valuation of liabilities for life insurers, because there's definitely an issue around entry and exit calculations. We need to monitor the treatment of DAC. That's all I had to cover, but tried to keep it quick on tax, but if there's any questions, I'm happy to take them. Don't all come at once.
Thanks, Ali. Any questions from the floor? None have come through from Slido as yet. I've got one for you then, Ali, to get us started. You mentioned right at the beginning there are benefits in looking at tax nice and early and incorporating it into the modelling. Can you elaborate further on that for us all and benefits that you perceive in doing so?
Well, if you think of the impact as 30% of your bottom line, at the end of the day, if there's a hit to, if there's additional income in a particular year, it's going to be 30% of that number. Right? And if there's an impact to deferred tax asset or liability, there's also impact on your accounts. So I think it'd be hard to explain later down the track that we haven't considered what the tax implications are, particularly around the life insurance businesses. I think DAC is an important one. So if we think that we've got big DAC balances that are going to have to be derecognised and they're going to hit the P&L, then the question around when do we get that deduction? And also thinking forward around, well, if we have big DAC costs, like, you know, maybe small insurers are in a different position to large insurers. And if there's a lot of commissions being paid out, for example, and it's a big number comparative to, you know, in the first year on loss-making businesses, then you'd sort of go, well, actually this impacts our business plan. And so if we, you know, going to end up in a loss scenario, and it's something to consider in your financial planning, I think. And so you can't ignore it in some ways. Yep. I know people like to ignore it, but we can't.
Any other questions from the floor?
Okay, thank you.
Thanks very much, Ali, for joining us.